Welcome back to the Behind the Well Show. I'm your host, Roger Abel, here with Elias Randall. Elias, I think I missed the last show. Did you do that with Jonas?
Jonas and I did do one recently. I don't know if it was the last one, but it was recent.
Was I the butt of all the jokes?
You always are.
I know. It was
Especially
probably a
when
really
you're
good
not
joke.
around. It's always easier to make fun of someone when they're not around, so that's typically what we do.
Well, they don't get to defend themselves. Jonas, I'm sure, did a good job. He always comes really prepared for our radio shows. Usually has some good tidbits of information that he likes to share with everybody.
Yeah, did you see his segment on the news the other day?
I didn't watch it, actually. That was yesterday.
Yeah, he did a really nice job. He went through a lot of just market-related commentary in an election year. And just, it's typical. Like, it's never as bad as what it's made out to be.
It's the number one question right now. I had 3 meetings yesterday. What should we do? It's an election year.
What was your answer?
Let's talk about our election year portfolio. And if anybody wants to find out, you can go to b2lshow.com. There's the plug for the day.
There you go.
No, it is the topic of conversation for most people. And I think it's because it's highly politicized and there's just a lot of things going on with it. And people are nervous because, I think they remember the last time, Trump was in office. And that was a little bit of chaos for people in general, just because he spoke every day. Every day he had a press conference. The current administration, they don't ever have a press conference. They never speak. So I don't know. I think people are just, both sides are worried about what's going to happen. And it doesn't matter if you're a Republican or a Democrat. You're worried about the other party. And I think it's
Rightfully
probably
so.
been that way through time, though. Has there ever been a time where both parties are on board for the same person? Of course not. Otherwise, there wouldn't be two parties.
No, but now it's just more prevalent now because of media and access to information. It's overwhelming how much politics gets shoved in front of people nowadays. But I don't know that anyone should really be that thrilled. If you watch the debates and you watch the 60-minute thing the other day, it's like the choices are okay. I don't know that there's a great choice right now, but it is what it is.
I had
It's what we get.
I had an individual in yesterday, and she made a really good point. She goes, well, the president's only part of the equation. There's three, parts to our process. There's three different houses, and they all have to agree to get things done. Like, just because there's a president there doesn't mean that what they want to do is actually going to get done. It has to get passed.
And the presidents of the past, they're not the common denominator throughout time, right? Like there's people that have been in our political system for years. They're in every picture with every president going back to the 80s. So they're a lot more involved than who. And the other thing, and Jonas made a great point, the election's about a month away. Well, we're also 4 years from the next election. We're never really that far from having another election. It's just constant, and it's always going to be in people's face.
I had an individual in here 2 days ago, and he works he's a county supervisor. And he said, what's interesting? I go around and I talk to all these business owners, and they need to buy equipment or whatever it is, and they all just say, well, I'm going to wait and see what happens with the election. And then a week after the election, they're still going to need the equipment. Like they think it's going to change their mind on whether they're going to need the equipment or not. But they still are going to go buy the equipment. He goes, it's really crazy that people are just like, well, I want to see what happens to the election before
I make this
decision. But he's like, if you need a road grader, you're going to need a road grader 45 days from now if you need it now. The election really shouldn't matter. So The election for most of people's decision-making shouldn't matter. Here's where I think it matters for people. If you are concerned about the outcome of an election, what it's going to do on the stock market, and you can't sleep at night, and you are in the distribution phase of life, you're taking money out, you need to have a really well-funded cash and liquid bucket. So if the market goes down 20%, it doesn't affect your life. It's that simple. Comes back to having a really good distribution strategy, a really good bucket strategy. That's how you plan all this away. I walked these individuals through it the other night, and they're like, well, that makes total sense. Why would I ever be worried about what happened then? I'm like, I don't know. Like,
There's not much you can do about it.
But most people, they look at their 401k account and they just see it as a big bucket of money that goes up and down. They haven't got to the granular level that, hey, I have X amount in cash reserves, got X amount in income, and I have X amount in growth, and then I have X amount in protected growth. Like, they haven't got to that level of detail in their 401k. It's just all a big bucket of money. They own a 20-30 fund, and it goes up and down together.
Right. Or the other thing I get a kind of a chuckle out of or get a kick out of when you hear people make comments, well, you know, when Trump was in office, my 401k was doing great, and then Biden got in there, or the other way around, right? It could be the other way around. I think one of the main takeaways, the great companies in America, they're not going to stop making money because of who the president is. Will their taxes change and will things change? Yeah, that stuff could absolutely change, but and you look at every past president, you look at all the market data, and after in an election year, I think the number was 83% of the time the market's positive that year. Well, the market's positive 75% of the time anyway.
Like, it's the same. It's not different.
Exactly.
It's
always the same. And the other thing to keep in mind, one thing I was thinking about the other day, even if corporate taxes and stuff change, the consumer is going to bear that cost anyway. The companies are still they're not going to become less profitable based on just some tax changes. They're going to pass that cost on to the consumer. So we're all going to bear that cost anyway.
I agree with that.
So,
one of the things I think about too, especially people that try to predict what's going to happen, they're going into retirement. They're like, man, I had an individual about 9 months ago sit in my office. He goes, I know the stock market's going down. I go, how do you know? Well, this, and this. I'm like, I hate to tell you, you don't know. And neither do I. But that person wanted to go into this really protectionism mode. You know, we found ways, creative strategies that they could still get growth, but not be sitting in cash, right? And, you know, we got lucky. We were right. Right? The market's up a fair amount since last January. But what I think about is if he didn't have an advisor, he probably just goes and puts that in cash. And this individual is like 56 years old. We're all living longer. As people live longer, they're going to need their money to last longer. So all of a sudden, these like small mistakes people make along the way, getting out of the market and missing out, it's going to pile up later in life if you live to be 100 years old. And we are. And here's the thing. We pulled it up on the radio the other night. You were there. By 2000, so today, there's 100,000 centenarians in America. That's 100,000 people over age 100 years old in America. By 2054, so arguably 30 years, I'll be 76, there's going to be 400,000 centenarians in America. So
that's crazy.
Here's the problem. It's not just that their money has to last longer, but if you start to look at quality of life and what things cost, we can't fix the body, we can't fix the mind yet, for the most part. So if all of a sudden people are living 4 times as many people live beyond 100, that's a whole nother layer of additional costs that's going to be bare. Nursing home, assisted living, in-home healthcare. And we're just looking at people over 100 because if 4 times the people live to be 100, what's the multiple of people that are going to make it to 90 now?
I would imagine that
it's at least more, 4 times.
Yeah, if it's 4 times the people 100, I would imagine the number of people living to 90 is at least 4. I mean, it has to be at least 4 times more. Okay. You have to be 90 before you're 100, but it's probably even more than that.
Right. And okay. So Elias, let's just think about the number of people over age 90 multiplying. And I just went and did a quick Google on this. 76% of people over age 90 needs some type of care.
76%?
76% over age 90 needs some type of care.
So that's almost all.
Yeah, almost all. Well, how are you going to pay for that? So back to my point, this individual at 56 makes a mistake and gets out of the market and misses out on, let's say this is $1 million account, misses out on this 15% return. It's $150,000. Well, what's $150,000 missed out on over 30 years? It's a massive amount of money. It's millions of dollars because they made one small mistake 30 years ago and thought they were going to outsmart the market.
One of the difficult things too when you're doing that, and we know some people that have been in cash for a long time because they think they can time the market. Well, this bull market is now basically 2 years old. So if you've been on the sidelines for the last 2 years in cash because you didn't want to get back in the equity market, what's your strategy going to be to get in now that we're trading near all-time highs? Because psychologically, what's everyone convincing themselves? I'm gonna buy the dip. I'm gonna buy the dip. I'm gonna wait.
Buy the dip's over. What was it about a year ago on the compound? They were talking about every time the VIX went to like 38, it was a buy. Every single time it spiked, it was a buy. Guess what the VIX is today? It's like 14. And for people that don't know, the VIX is the volatility index. And every time it spiked, it was a buy. And it has been. Yeah. People just think that the market's going to stay depressed forever, and it's just not going to. Companies adapt to become profitable.
And I think right now for people trying to time the market, we're kind of in this, it's almost like a grind higher, where we might have a volatile day here and there. In August, we had some really bad trading days, but then recovered right away. So I think people see that, and then they start to think, okay, this is going to be the 10 to 15% pullback I'm looking for.
Well,
and then I'm going in, and then we grind higher, and we go back a little bit, and then grind higher. It just gets really hard. Once a bull market's starting to mature and it's been going on for 2 years, it gets really hard to figure out when you're going to go back in.
I shared with you this a few years ago. I used to trade Treasury futures. And I told you, when it's hard to buy the market, like right now it's hard for people to buy, a lot of times that's the time to buy. When it gets easy to buy it, probably on the wrong side of things. Well, like right now, psychologically, it's hard to buy. Well, and this is what people should remember. It might be all-time highs today. But over the next 30 years, this likely is not the all-time high. So where you buy it, what you think you're going to get 3 or 4% better entry point or 5%? No, you won't, because if it goes down 5, you're definitely not going to buy it because you think it's going down 10.
That's the psychology of it.
This is what people need to do if they're nervous to get in the market but want to be in the market. Take the amount of money. Just, hey, I'm going to put a third in this month, a third in next month, a third in the following month at whatever price it is.
Yeah, define your
investment
time
strategy.
Period. Yeah. Define your strategy and
define your risk tolerance. Know how much risk you need to be successful. If you don't need risk, then okay. But most people have to have some level of exposure to the stock market to be successful. If you have 2 big pensions, 2 good Social Security checks, and you're sitting on a couple $1 million, you probably don't need a whole lot of risk, depending upon your lifestyle.
Right? Which even at that point, we know investors like that they do want to be growth-oriented investors, though, because they're looking at more legacy planning. So in their minds, they're investing these dollars for future generations. And the other thing, which this is a longer-term view, and in the short term, we can always have volatility, and we will have another bear market. Where, in our lifetime, we're going to have several, most likely. But I think when you really look at all of the data, we're in a bull market. Our investor class in America is growing. We're getting more and more participation into the equity market. So that's very favorable long term.
Well, just think about more people invest money. They're buying more things. When you buy, it causes the price to go up.
Right. There's nothing signaling demand for stocks going down.
Look back to COVID. COVID brought an entire new generation, whether for good or for bad, of investors into the market. You know, we saw all the day trading stuff and the memes and the Robinhood stories and options. And while some of that stuff is dangerous and some people lost a lot of money, it got this younger generation interested in the stock market. I can't tell you how many clients I have. They're like, yeah, my 16-year-old who has a job, you know, they're playing around with the stock market. I'm like, that's good. You know, they're buying this stock. What do you think? I'm like, well, I don't buy individual stocks typically. I said, but if it gets them interested, this is their ability to go learn.
And the great news about people who are, well, certainly 16. I just met with someone the other day, 27-year-old, wants to get started, wanted to know if they could work with us and keep their Robinhood account. Here's a great thing about young people in trading. They don't have enough money to blow up their situation.
Yeah.
So you're going to learn, I said, you're probably going to learn some lessons. Some will be good, some will be bad, some might be painful, but the reality is you don't really have any money right now. So what are you going to lose by doing some trading? Even if it blows up, okay, you lose a couple $1,000s.
Here's the thing too. Like, if a 16-year-old, 18-year-old, 20-year-old, 22, whatever young person went out and just got an advisor and just bought a boring growth-oriented portfolio, that would not probably be stimulating enough for them to keep doing it. Part of investing, and you'll agree, most of this is psychological. Well, psychologically, if they're trading and having a little bit of fun, even if they're not making money, it's keeping them in the game. They're not getting bored, and they believe it's important to invest money. Eventually, they're going to figure it out. They're going to figure it out and be like, okay, I messed around with all this stuff. I'm just better off putting it in this fund, letting this thing grow, letting it work and do its deal.
Let the professionals do their job.
And you know what? If you're young and you're accumulator and you think you can do this on your own, it's a lot harder to mess it up at 28 than it is at 58. At 58, it's distribution strategy and different stuff. I mean, if individuals focus on what they can control and they buy good investments, things tend to work out. What can you control? The investments you buy and how much you put in. That's really it.
Yeah.
Like, I mean, you think about
and
it.
How much you take out.
Yeah.
You're spending.
Yeah. But if you're a 25-year-old, your sphere of control is contributions, where it's at. That's it.
Right. And contributions, and then pick a solid investment. Pick something that's been around. Pick something that has a manager has a proven track record, or just go participate. Go buy an index, participate in the growth of the economy.
Yeah. Okay. I'm going to switch gears a little bit because this just happened about 2 weeks ago. An individual or a rep in our office, individual came in and their advisor suddenly, the firm he worked for suddenly went out of business. Like they just closed their doors, and it's a big national firm. But they closed this branch location, and the individual client was concerned about their money. So I thought it would be good to cover some of the things to think about or do if your financial advisor suddenly leaves the business. And what do advisors leave the business for? I hate to tell everybody, at some point, your advisor's retiring. Like, at some point, they're going to retire. At some point, they're going to die. They may switch firms. They may decide to do a different career. They could have a regulatory event. There's a whole bunch of different reasons people leave the industry or go somewhere else. And most of these are things you should expect. So the first thing to do if your advisor decides they're not going to be in business anymore, or they just sell their firm, they go to a different firm, the first thing to do is not panic. I think, I just think about clients, and if for some reason, let's say I passed away, right? I believe there'd be some clients who would panic and be like, what are we going to do? The good news is we've set up this infrastructure here that most of the people I work with know that you're the Mack truck rule. And the Mack truck rule is if Roger gets hit by a Mack truck, what happens to my stuff? So we have a contingency plan. there are a lot of firms out there, whether good or bad, and I'm no way being disparaging, that it's an individual practitioner and maybe one assistant, and there maybe is no plan in place. Now, most broker-dealers try to have some continuity plan, but it might involve someone you don't know. So first thing to do is just don't panic, okay?
Yeah, and I think most of our clients, I personally believe a lot of people join us and use our firm for these services because of the size of our company and because they know it's a place where they can always be taken care of. Not like the situation you just described. I mean, people would be, I'm sure, worried and devastated by that, but they know that they're going to continue being taken care of and they don't need to go right. That's a big change. They just got emotional news, but they don't have to go interview and hire someone else.
And the one thing about this company, I think the company closed their doors. My guess is that this advisor is going to go somewhere different. You know what I mean? Most of the time, likely he's going to go somewhere different. This shop, it wasn't a regulatory event. It was, hey, the company was just eliminating this location. It's a big national firm. We're going to eliminate this location. So in that case, most of those clients probably can go with that advisor wherever they go. It's kind of like the advisor switching firms, and that happens. You know, it's just like advisors are like other people. You know, the firm you're affiliated with may change over time, just like most people, they change jobs over time. And,
True.
You know, if you're in the independent world, it's pretty easy to follow your advisor where they go if that's what you wish to do.
Yeah, and I think the other thing, if that happens, clients and consumers do need to understand your accounts. Like, your accounts are your accounts. They're still going to exist somewhere. I mean, even if our firm ceased to exist tomorrow, every client we manage money for would still have their account with their money in it.
They would just have somebody different servicing it.
Yeah, someone real, you know, an 800 number would call you, someone locally in town, something would happen, but your money wouldn't disappear just because the firm goes out of business.
Right. So step one, don't panic. The second thing I tell people is make sure you have access to all your stuff. Like, have your statements ready, because what's going to happen if you have an advisor who no longer is working with your accounts, you're going to get a couple of options. One, you're likely going to be able to leave them there. Our broker-dealer's LPL. If we left LPL would just take over the servicing of these accounts.
They'd be happy to keep the clients.
Yeah. So they'll have option one, just keep the accounts there. Option two, you'll be able to move the accounts to wherever your advisor went or to a different advisor, whatever you wish to do. But you need to have your account statements. That's the number one thing you need to have. Go get a copy of your statements. If your advisor is no longer here, figure out where to get a copy of your statements.
And I think the important things, okay, why do you need the statement? The reasons would be, one, there's going to be some sort of phone number to contact a back office. There's going to be your account number, which is going to be very important if you're going to move any money anywhere. And then it's also going to show the investments too, right? Because if you're going to move money to a new firm, they're going to want to see what it is, because then that's going to help them make decisions as far as how they're going to help you.
Second thing, find out who's going to take over the accounts. Are you going to be a house account? Are you getting a rep? Is your rep going to a different firm? You got to find out who's going to manage the account. If your rep's going to a different firm and they're with an independent company, likely they're going to be giving you a call or sending you a letter letting you know where they went. Okay, so figure out who's going to take over your accounts. Third, you got to interview some new advisors. If your advisor left the business, either by his choice or her choice or for some other regulatory reason, you're going to need to interview advisors. You know, how do you pick an advisor? It's not, I mean, there's a lot of advisors. How do you pick them? How would you pick one?
For me, I believe the most important things are, first, I think the relationship and the trust that you can have with that firm. I don't think there's value, there absolutely is value in the philosophy and how the money is managed. For the most part, every person in the business, if they know enough about you, can get you a good portfolio. I think you need to work somewhere that, one, you like and know and trust, and two, personally, which I'm biased in this because of how we run our company, but I would want a firm that has infrastructure. You know, if I'm going to hire somebody, I personally don't want to call the advisor to update my address or my beneficiaries. Like administrative things, I want to know when I call can just be taken care of. I know that person's busy. So one, I wouldn't want to bother them with it. And two, I would want to know that they have staff and a service team that can provide high customer service, because people shouldn't call in with, oh, I want to update my beneficiaries and don't hear back for a couple weeks, right? And then the work's not getting done.
Right.
Where I think you can run into that if it's and I'm not knocking solo practitioners, but when you're a solo practitioner, you are the business owner. You're doing all the marketing, all the meetings, all the paperwork. That's a lot of different hats you have to wear to run a company.
I think the good news, though, today, I don't think there's that many people that are true solo practitioners anymore. I think the broker dealers do a good enough job of providing resources. You can hire a virtual admin to help support you. I think that's the good news. I don't think there's that many of those people out there anymore. But there's a lot of places who it's one advisor and one staff person. And it goes back to the question, if your advisor left, do you want to go through this again? Or do you just want to get with a firm where regardless of who's there, you're going to get taken care of? Someone's going to understand your situation. And, you know, we've always embraced that team approach here. Most clients of this firm have two people that are pretty knowledgeable about their accounts. Like I could substitute you for most of my client meetings, and the clients would have the same outcome whether I was there or not, because we have the same investment philosophy. We give the same advice to everybody, but also you already are familiar with everybody. We've introduced you to almost everybody.
Yeah, I kind of, for the most part, understand
their situation.
And how they like to do business.
Yep.
Yeah, that's a good point.
I think another thing that would be very important to me, and I truly believe this, that at some level, you should like the person you're doing business with. You know, if you're going every time and it's like going to the dentist and you're fearing that you're going to get a tooth pulled, that's not a healthy relationship to be in. Most of the customers that I work with, we have a general, like, pretty good time together. You know, we get serious about their money, but we have other things that we can talk about and we enjoy the time together versus they're just here for a meeting. And typically if they're just here for a meeting and they don't enjoy coming here, they're going to find another advisor in this office to work with. And it's happened. I mean, you know, we've had joint meetings where the personality gravitates towards one person than the other. And that is kind of that's
I know there's absolutely people that like you better than they like me and the other way around, but that's just human nature. Right?
I actually had somebody tell me a referral. This is great. So you know who I'm talking about. I called up, I talked to an individual on the phone. They've been a client for a long time and they referred someone to us and they go, yeah, so-and-so, they really like Elias. I'm like, wait a minute. They like him better than me.
But I don't know that means they like me better.
I got the feeling.
Maybe they do.
Yeah, maybe they do. But that's okay. Also the cool dynamic of working with a firm that has more than one person. Hey, if you gravitate towards one person, what happens? Just work with that person. Should be amicable. You should enjoy the time you're doing this because there's somebody else out there that you'd be a match with.
And I personally like having at least a little bit of friendship with the clients. I mean, I know at the end of the day, it's serious business. They're trusting us with their life savings, so we have to take that personally. But I do like to have fun too, right? So to be friendly, have some friendship outside of the business relationship, and get along. It makes it fun. Like you can go to happy hour with people, coming to the office, telling stories about kids and grandkids and having a good time. I mean, those make it really, really an enjoyable enjoyable experience for everyone, us and for the clients.
For sure. So I thought that'd be good to cover because it was brought up by an advisor in the office that, this firm went out of business in a different city. It's not even a city we're in, but they chose to come here. They'd heard us on the radio and just had trust through that. I know we just finished up talking about advisors, but something came to mind, and I think it's really interesting how things work. But about a month ago, Federal Reserve cut the interest rates 0.5%. And everybody's like, man, interest rates are going down. When they cut the interest rate, that's the overnight lending rate, right? Fed's funds rate. The 10-year Treasury, the yield on the 10-year Treasury was 3.6%.
And it's gone up since then.
It's over 4%. So this is where people have a disconnect because they just saw this interest rate go down, get cut 0.5%, but mortgage rates went up 0.5%. Think about it. Think about how confusing that is to the individual investor. And I think that investors need to realize that most of the interest rates you see on car loans and mortgages and whatever you're borrowing money for, a lot of it's tied to the 10-year Treasury. You want a mortgage, it's tied to the 10-year Treasury. You can look at historic spreads between the 10-year Treasury and mortgage rates at about 2%. That's probably where the mortgage rates are going to be. That's all through history. But people just thought, whoa, interest rates went down. It's going to cost less to get a house. No, it's not.
It may eventually, but right now it's not.
And it kind of brings up another point of like trying to predict interest rates. Predicting interest rates is like predicting the stock market.
Yeah, it's
hard to time.
It's hard to time either market.
Really. You can't time any of those markets. And it's like, oh, people aren't buying homes because they're waiting for interest rates to go down. Well, since they cut interest rates, unemployment went down. That's not good for more rate cuts. Inflation went up. Inflation today came out 2.4%, hotter than expected. That's not good for interest rates. There's a war in the Middle East. We have 2 presidential candidates that both are going to spend a whole bunch of money, which will probably be inflationary. I mean, just think about all these things, and people are waiting to buy a house because they think rates are going to go down. Well, yeah, but if inflation goes up 3 or 4%, does that rate really make up for it? Like, people are putting all these decisions on hold because they think interest rates are going down further.
Yeah, and when the economists and people I've been following and listening to, and I'm tending to agree, it's kind of tricky to figure out where is this economy and what direction are we going? But I've heard some people talk about they feel it's like a mid-cycle economy where we're not to the point where it's, like 2021, where just everything is going up in value and there's all this spending and all this stuff going on. So I think, we've had economic slowdown, but even it's odd because even with the layoffs, companies still have a lot of money, and I think they will eventually bring people back. But I was just meeting with a friend of mine who's a corporate pilot, and they're still flying around and having meetings, which that's and they've done some restructuring in their company, but I think what companies are doing is they're trimming the fat. I don't know that they're actually really at this point getting prepared for a really harsh recession. I think what's common is there's some senior level positions. They're offering retirement packages and stuff. I think salaries kind of at the higher end where you're getting paid several $100,000 a year, and now the people above you are starting to wonder, what are they actually doing for that money? Or has their salary just kind of bloated over time because they've been with us for a long time? I think there's a lot of that going on.
Well, that's the silent layoff. Hey,
yeah,
we're not going to lay anybody off. We're just going to offer you a really good package to leave. And yeah, up front, it costs the company some extra money, but over time.
But they're going to fill that position with someone that they're going to pay 30% of what they're paying that 60-year-old person.
So over a 5 and 10 year period, those numbers look way better.
Yeah.
No, I think it's interesting you bring that up because I think there's certain parts of the economy that are still doing really good. But then you can go look to like the ag sector. Yeah, I had an individual in here the other day, and they sell seed, and then her husband does some consulting in the ag industry. And they're like, most of these farmers lucky to break even this year. Like, so think about it, they're going to work for nothing and maybe at a loss, and then next year, guess what? Fertilizer cost is up, implement cost will be up, but if grain prices don't go up,
yeah,
they're going to lose money.
Yeah, their operating costs are super high now.
Yeah, well, yeah, and I mean, the price of grain is half what it was 2 years ago. So there's parts of the economy that are definitely softening and are adjusting. It's just how bad is it going to get?
Well, no one knows.
Nobody knows. And I don't know if it'll get bad. But I just think that, it's I just had that thought about interest rates come to mind because everybody just thought, oh, this is great for the economy. And, maybe.
Maybe. Things are typically never as great as what everyone thinks or as bad as what everyone thinks.
Well, it makes me think, so we had all this massive inflation and 18 months later we think it's over. Like, is it really that easy to beat it?
Well, of course, of course Americans do.
Right.
We're so addicted to spending money and being consumers.
Which, guess what that does?
And everyone has all this wish. Everyone that wants to trade a house right now, get the next one, move up in a house, buy a new one, they're so wishful and hopeful for lower interest rates to finance the mortgage or even for real estate prices to come down.
And they're not coming down.
They're not. The houses are staying for sale longer, but it's almost recency bias. We're comparing that to a couple years ago where you'd put a house on the market and 2 days it's sold.
Right.
Well, now houses are sitting for sale sign in the yard for a month or two. That's probably more normal than what we had a couple years ago, but everyone remembers how it was a couple years ago.
Well, and anybody can list a property or real estate for sale for whatever price they want.
Yeah, it doesn't mean someone's going to buy it.
Yeah, what I've noticed is stuff that is newer and priced well, not even well. Like, I watched a property on a local market that I'm like, I was like, that's a really nice place. It sold the first day. But then I've watched other properties. These things have been for sale for a year because they're giant homes. They haven't been updated in 30 years. They need a total renovation. Well, who wants to go renovate 12,000 square feet?
That's a tough sell right there.
Yeah.
When you can go build exactly what you want.
You can go build what you want, build five, because I go through the bucket list. Who's like, man, I want a 12,000 square foot house. Like, that's the desire. It's typically, I want these really cool things in my home and this great living space, but I won't say nobody.
12,000, that's the size of a grocery store.
Yeah, most people,
why do you need a house that big?
It'd be cool, but could you imagine?
If your house is the same square footage as a grocery store?
Could you imagine, though? Because my wife looks at all this stuff. I'm like, dude, that's great that's the price of that place. But you know what flooring cost in 12,000 square feet is? You're going to spend like $250,000 in flooring.
Yeah,
that doesn't include the
cost,
paint and the trim it's just all the stuff. So that's why some of these homes aren't selling. But these newer ones, not new construction, but stuff that's been built in 5 years, priced fairly updated, they move right away. So there's still sales out there, but some people are still asking a just astronomical amount of money for these things, and those days are over.
Yeah, that's right. Though those days are over. Just throwing a price and then people come in. But the fair deals, it's a good house. It's modern. It doesn't look like it was decorated in 1987.
I'll give you a good example.
Those houses are selling.
The place we're at Lake of the Ozarks, there used to be like one available per month maybe. Well, now there's like 7. The prices aren't less. The prices are the same. There's more selection, right? The prices are actually higher. Well, what'll happen? There's a little competition now, right?
Mm-hmm.
But that doesn't mean prices are going down. Like,
the increase will slow down, though.
Right. The increase will slow down.
Yeah.
So I want to thank everybody for listening, and hopefully you have a great day.
Securities and advisory services offered through LPL Financial, a registered investment advisor, member FINRA SIPC. The opinions voiced in this show are for general information purposes only and are not intended to provide specific advice or recommendations for any individual. To determine which investments may be appropriate for you, consult with your attorney, accountant, and financial or tax advisor prior to investing. Premier Investments and Wealth Management and LPL Financial do not provide tax advice. Please consult your tax professional. Economic forecasts set forth may not develop as predicted, and there can be no guarantee that strategies promoted will be successful. There's no guarantee that a diversified portfolio will enhance overall returns or outperform a non-diversified portfolio. Diversification does not protect against market risk. Rebalancing a portfolio may cause investors to incur tax liabilities and/or transaction costs, and does not assure a profit or protect against loss. All performance referenced is historical and is not a guarantee of future results. All indices are unmanaged and cannot be invested into directly. There is no assurance that the techniques and strategies discussed are suitable for all investors or will yield positive outcomes. The purchase of certain securities may be required to affect some of the strategies. Investing involves risks, including possible loss of principal.